Welcome to the new era of video creation with AI stock picking. Let's start it. Here are the contents. Alphabet, the parent company of Google, is one of the most essential players in the global tech ecosystem. From search and Gmail to Android and YouTube, it touches nearly every connected user on the planet. Its advertising engine, driven by Google Search and YouTube, is a cash machine, fueling innovation across newer segments like Google Cloud and artificial intelligence. One key reason investors like Alphabet is the balance between stability and ambition. It generates massive free cash flow from ads, but it also reinvests aggressively into AI via its Gemini models, DeepMind research, and cloud infrastructure. Google Cloud is now a real profit center, while Gemini is directly competing with OpenAI and Microsoft. However, it's not all upside. Alphabet is still largely dependent on ads, which makes it vulnerable to macroeconomic slowdowns or shifts in digital privacy regulation. Its AI tools are improving but face stiff competition, and its other bets, like Waymo, continue to burn cash. Alphabet's stock is solid, but the entry point matters. Like most mega-cap tech, it trades at a valuation that assumes strong forward growth. This talk breaks down where the stock is now, what a fair price looks like, and how patient investors can find a better risk-reward setup. Alphabet is currently trading around $180 to $185, near its all-time high. The market responded positively to its most recent earnings, where Google Cloud posted its best quarter ever, and ad revenue growth resumed after a few stagnant periods. Investors are also excited about Gemini, Google's flagship AI model, which is being integrated into Search, Workspace, and Android. However, the current valuation is on the higher end. With a forward price-to-earnings ratio of about 24x, Alphabet is being priced as if it will deliver high and consistent growth. That's possible, but not guaranteed. The AI space is fiercely competitive, with Microsoft and OpenAI moving fast. Moreover, monetizing Gemini at scale, beyond just cool demos, takes time. This means that today's stock price includes a lot of optimism. While Alphabet is still a fantastic long-term investment, buying at peak sentiment and valuation could reduce your margin of safety. If the company simply meets expectations, or faces macro or regulatory headwinds, we could see a pullback. For investors willing to wait, even a modest 10 to 15% dip could offer a much more favorable entry point. That's what we'll explore in the next slide, finding a valuation zone that lets you benefit from Alphabet's growth without overpaying for it. The sweet spot for buying Alphabet is between $150 and $165 per share. In this zone, the valuation comes down to about 21x forward earnings, aligning with its long-term average. That may sound modest, but it's crucial. Paying less for the same future earnings significantly improves your expected return while lowering the chance of drawdown. Historically, Alphabet has seen strong institutional buying near the $160 level during volatility, including during market-wide pullbacks and tech-specific corrections. These support zones are not just technical levels. They reflect where smart money sees relative value. Getting into Alphabet at that price means you're not just betting on AI or ads. You're buying a diversified, highly cash-generative tech company at a fair price. The risk-reward ratio becomes much more attractive. You're positioned to benefit from a re-acceleration in digital ad spending, continued growth in Google Cloud, and any breakout AI monetization, without paying for it all up front. Of course, timing the market perfectly is difficult, but having a buy zone helps you stay disciplined and resist buying at euphoric highs. Alphabet has plenty of long-term upside, but entering at the right price is how you maximize it safely. One of the biggest reasons to hold off on buying Alphabet at current levels is that much of the AI excitement is still speculative. Yes, Gemini is powerful and impressive, but meaningful monetization across search, docs, and cloud is still in the early innings. You're paying for a vision that may take time to fully realize. Additionally, Alphabet's biggest revenue driver, digital advertising, is highly sensitive to economic slowdowns. If businesses pull back on ad spend, Alphabet's top line takes a hit. This is especially relevant in a climate of rising interest rates, inflation, or global recession concerns. On top of that, regulatory pressure is a growing risk. The DOJ's antitrust case against Google continues to loom, and European regulators are tightening data and privacy rules that could hurt targeting and ad effectiveness. These are real threats that investors tend to forget during bullish phases. Lastly, Alphabet tends to see 10–15% corrections at least once a year, even in good years. That's the opportunity. Buying during those dips lets you avoid paying peak multiples and sets you up to benefit from rebounds. Patience isn't just a virtue, it's a strategy, especially in mega-cap tech. Alphabet is undeniably one of the strongest companies in the world. Its dominance in search, video, mobile, and now AI makes it a core part of the digital infrastructure. It's innovating across everything from AI to autonomous vehicles to quantum computing. That's why it's a strong long-term hold for many investors. However, the market often prices imperfection, and right now Alphabet is near those levels. To get the best long-term results, you don't need to chase. You just need to wait for the inevitable pullbacks and be ready to buy when they happen. Entering between $155 and $165 offers a solid balance of valuation, growth, and risk management. Remember, great companies can be poor investments at the wrong price, but at the right price, they can become wealth-building machines. Alphabet has the scale, the cash, and the strategy. All you need to do is add price discipline. Don't let short-term hype cloud your judgment. When the market offers you a great business at a better value, that's when you make your move.